Let's shatter a myth right at the start. Most people think the Federal Reserve raises rates to stop greedy price gougers. They picture a stern parent taking away the economy's credit card. Here's the thing. That's not the main story at all. The true tale is far more intricate and, honestly, more dangerous. It's a story about a necessary medicine that can itself become a poison. We're talking about the double-edged sword of interest rate hikes. This tool is wielded by the Fed in a high-stakes balancing act. But what happens when that scalpel slips? Imagine the entire economy as a giant, complex engine humming along. That engine runs on a fuel called cheap money. When loans are inexpensive, businesses expand and hire more people. Families buy homes and cars, feeling confident about the future. This spending heats up the engine, sometimes too much. Now picture prices starting to climb faster and faster. Your grocery bill, your rent, your gas, it all gets more expensive. That's inflation, and it's the Fed's ultimate enemy. So, the Federal Reserve steps in, like a mechanic adjusting the fuel mix. They announce a hike in the federal funds rate. But what does that rate actually do? It's the baseline cost for banks to borrow money overnight. Think of it as the prime domino in a massive financial chain. When it goes up, everything else follows. The interest rate on your savings account might creep up, which seems good. But here's where the first cut of the sword happens. The rates on business loans, mortgages, and credit cards soar. Suddenly, that new factory expansion looks too expensive to finance. That dream home is now hundreds of dollars more per month. So you decide to wait, and so does everyone else. Economic activity, that humming engine, begins to slow down. But wait, isn't that exactly what the Fed wants? A controlled cooling is the entire goal. They need us to spend just a little less to bring prices down. It's a delicate tap on the brakes, not a slam. But how do they know how hard to press? What if our foot slips on that pedal? History is littered with examples of brakes slammed too hard. The Fed is navigating by looking in the rearview mirror at old data. They see inflation reports from months ago. They make a decision today that won't fully hit the economy for maybe 18 months. It's a terrifying lag, like steering a supertanker. You turn the wheel, but nothing happens for a mile. So you turn it some more, hoping you guessed right. Now, let's zoom in on the average American family. They're already squeezed by high prices at the store. Then their credit card minimum payment jumps up. Their adjustable rate mortgage payment is about to reset higher. Their student loan debt just got more burdensome. What's the first thing they cut from their budget? Probably that weekend trip, or dinners out, or a new appliance. Now, multiply that decision by millions of households. The local restaurant sees fewer customers. The hotel has empty rooms. The appliance store lays off a salesperson. Do you see how one policy ripples out? This is the transmission mechanism of rate hikes. It doesn't just fight inflation in some abstract way. It intentionally creates financial pain to reduce demand. But what if the pain becomes too widespread? What if the slowdown isn't gentle, but a sudden stop? Let's pick up with that laid-off salesperson from the appliance store. Her name is Maria, and she's just one tiny data point in a vast system. Now she's cutting her spending to the absolute bone. That's less money flowing to her landlord, the grocery store, and the gas station. But wait, her story is just the beginning. The business owner, let's call him David, is feeling the pinch even more sharply. He owns a small manufacturing company that makes parts for new homes. His line of credit just got a lot more expensive to maintain. The big contract he was bidding on. The client just postponed it. Financing for new equipment is now off the table. So what does David do next? He freezes hiring first. Then he might have to lay off a couple of his team. He delays upgrading his delivery van. He stops ordering supplies in bulk. Every single decision is a withdrawal from the economy's bloodstream. Here's the thing. David isn't being cruel or panicked. He's rationally responding to the new, more expensive cost of money. Money itself has a price tag, and the Fed just raised it. And this is where the second, deeper cut of the sword swings. It hits the world of big corporations and Wall Street. Think about a giant tech company that grew on cheap debt. For years, they could borrow billions for almost nothing. They use that cash to hire thousands, experiment, and buy back their own stock. What happens when their debt rolls over at a 7% rate instead of 2%? Their entire profit calculation changes overnight. Suddenly, those speculative moonshot projects are the first to get axed. Their stock price might tumble as investors recalculate their value. And what about the stock market in general? Higher interest rates offer investors a new, safer choice: government bonds. Why risk your money on a shaky company when you can get a solid 5% from Uncle Sam? So, money begins to drain out of the stock market. That means less capital for companies to grow. It also means your 401k statement might look a lot less healthy. Feel that? That's the wealth effect, or rather, the reverse of it. When people see their retirement savings shrink, they feel poor. And when people feel poor, they spend even less. It's a vicious, self-reinforcing cycle. But the Fed isn't just watching from the sidelines, are they? They see these early warning signs: the layoffs, the falling stock prices. Their internal models are flashing yellow, yet they're also staring at stubbornly high inflation numbers. They're terrified of stopping too soon and letting inflation become entrenched. Remember that supertanker lag? They might have already turned the wheel too much, but the ship hasn't yet responded. So they might signal there are more rate hikes coming. That statement alone can send a chill through the boardrooms of America. Business leaders hear that and slam the brakes even harder. Why invest today when borrowing might be even more expensive tomorrow? This is called forward guidance, and it's a powerful psychological tool. But can it be too powerful? What if it scares everyone into a deep freeze? Let's not forget the housing market, the most interest rate sensitive sector of all. A young couple gets pre-approved for a mortgage at 7%. They look at the monthly payment and their hearts sink. The dream is deferred, maybe for years. Home builders see the orders drying up and they stop building. Real estate agents, mortgage brokers, and construction workers face lean times. This isn't just a sectoral slowdown. It's a cornerstone of the American economy cracking. And the crack is spreading. Now picture those cracks spreading into the financial plumbing itself. This is where the story gets technical, but stick with me. It's crucial. Banks make money by borrowing short and lending long. They pay you a little interest on your savings account and charge a borrower more for a 30-year loan. But here's the thing. When rates rise rapidly, that model can break. The bonds and loans a bank already owns from the low-rate era lose value. Why would anyone want a 3% bond when new ones pay 6%? So the bank's balance sheet, its financial health, quietly weakens. Meanwhile, depositors like you and me might start moving our cash to higher-yielding accounts. That drains the bank's cheap source of funding. But wait, it gets trickier. Remember all those years of near-zero rates? They pushed investors to hunt for yield in risky, obscure corners of finance. Private equity, venture capital, commercial real estate, all fueled by cheap debt. What happens when you suddenly take the cheap debt away? These risky assets can plummet in value and fast. A major investor or a hedge fund might face catastrophic losses. And in our hyper-connected world, one firm's failure can threaten many others. This is called financial contagion, and it keeps Fed officials up at night. They're trying to cool the real economy, but they might accidentally break the financial one. So we have a slowing Main Street, a shaky Wall Street, and a nervous banking sector. The pressure is building from all sides. But the inflation data still looks sticky, right? Maybe rent costs are still high, or service prices won't budge. The Fed faces an agonizing choice. Keep hiking and risk a break, or pause and let inflation run. This is the moment the double-edged sword is most dangerous. Their credibility is on the line. If they back down, everyone might think they're soft on inflation. Expectations could become unanchored, meaning we all just expect high prices forever. And if that happens, their job becomes almost impossible. But if they press on, they might trigger the very disaster they're trying to avoid. What's the lesser of two evils? History shows us they often choose to break the economy's back to kill inflation. It's a brutal, calculated trade-off. Paul Volcker did it in the early 1980s. He cranked rates to unheard-of levels to slay runaway inflation. And yes, it caused a brutal recession. Unemployment soared past 10%. Factories shut down. It was economic medicine that felt like poison, but it worked, eventually. The question for today is, are we in a Volcker moment? The Fed chair isn't just a banker, they're a psychologist managing the nation's mood. Every word they say is parsed for hints of fear or resolve. A single misplaced phrase can spark a market rally or a crash. They walk a tightrope without a net, high above a roaring crowd. And the crowd, that's us, is getting impatient. We feel the pain of higher costs and tighter budgets. We read the headlines about layoffs. We wonder, when will this end? Is the cure becoming worse than the disease? That's the tipping point we're exploring. The moment the necessary cooling becomes a destructive freeze. So, when does a controlled cool become a destructive freeze? It's not a single moment, like a light switch flipping. It's more like a chill that seeps into the bones of the economy. One day, businesses aren't just postponing expansion, they're fighting for survival. Layoffs shift from being cautious to being widespread. Unemployment ticks up, then climbs, then jumps. And here's the thing. Job losses don't stay in one sector. They ripple from tech to manufacturing, from construction to retail. Maria's story becomes David's story, becomes your neighbor's story. Consumer confidence, that fragile feeling about tomorrow, plunges. People don't just cut back on luxuries. They delay doctor visits and car repairs. They fear their job might be next, so they hoard every dollar. This is called the paradox of thrift. What's smart for one family, saving more, is catastrophic when everyone does it. Economic activity doesn't just slow, it seizes up. Demand collapses. And with collapsed demand, prices finally start to fall. The Fed wins its war on inflation. But wait, look at the battlefield. They've won by creating the recession they hoped to avoid. The double-edged sword has cut deeply on both sides. This is the inherent danger in the medicine. The The recession isn't a bug in the system, it's often the featured mechanism. It's how rate hikes do their gruesome work. So was it worth it? That's a question for historians and politicians. Families who lost homes in the 1980s or jobs in 2008 might say no. Central bankers, guarding the long-term value of the currency, might say yes. But the real insight is this. There are no clean victories in this fight. There is only a balance of pain. The Fed's job is to choose which pain is less damaging over time. Letting inflation run wild erodes savings and crushes the poor. Inducing a recession throws people out of work and destroys dreams. It's a horrific choice. And this is why economics is called the dismal science. Our story doesn't have a classic happy ending. It has an ending of trade-offs and scars. The hopeful part is in the recovery. Eventually, with inflation tamed, the Fed will lower rates again. The cheap money will slowly return like a spring thaw. Businesses will tentatively start to hire. Investment will cautiously begin to flow. The engine will sputter, then turn over, and finally hum once more. But the memory of the freeze will linger. It will change how people spend, save, and borrow for a generation. It will shape the next set of rules and the next Fed chair's dilemma. The double-edged sword is carefully placed back in its sheath until the next time the economy overheats and the cycle begins again. The fundamental truth is this. The tool designed to ensure stability carries within it the seed of collapse. That is the central paradox of modern monetary policy. It is a story of power, intention, and unintended consequences. A story where the cure and the disease are forever intertwined. And it's the secret story behind every headline, every rate decision, and every recession that ever was. The money behind America is never just money. It's a story about us.